Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what people are sharing. If you want to follow me at Finance, and if you want to join our community, finding-value.com, I dive deeper into all these topics, looking for investment opportunities and sharing them with everyone in the community. We have special is the coupon code for both monthly and yearly savings for the community. So, starting with Patrick Karam, he says crude oil and silver ultimately go where gold goes. Totally agree. Totally agree. I'm glad they're looking at this from a longer term perspective. We've got higher lows for oil, gold, and silver. This is oil's yearly log chart as it continues to work its way on up, along with the cup and handle that we've got on silver's log chart. And then we've got the higher lows and highs on gold that's already broken out. I do think silver is going to follow. I do think oil is going to follow. And I think that the main driver is going to be interest rates. Watch interest rates, the value of the dollar and interest rates. I think interest rates will continue to go up, and we could see a divergence between interest rates and the dollar, where the dollar starts going down while interest rates go up. I think gold's going to be a viable alternative to the bond market. I think people are going to choose silver because they have to. It'll almost come, return as money, so to speak. And oil, I think, will be the driver of all of it. I don't think gold is in the driver's seat. I think gold is a function of the situation that we're in with our currency, but I think oil is the balancing factor of our currency. As money gets created, what balances out the inflation aspect is oil increasing in production and keeping GDP in lockstep with money creation. If there's an imbalance between money creation and oil production, that's when you get these large inflationary periods. 1970, we hit peak oil production of conventional oil. In the mid 2000s, we started to create a lot of money, which was the money creation against homes. That's generally the factor of the real estate cycle. And oil couldn't keep up. And now it's the entire world's oil production probably peaking soon. My guess probably sometime around the next few years would be my guess is where demand starts to outstrip supply. And then people run to gold and silver to protect their wealth against currencies that are having problems, bond markets and currencies. The bond market will have problems first. That's when interest rates go up. And the dollar will go down because they'll save the bond market and sacrifice the currency. That's the dynamic that I think will come with time. Uh, in the short term, we could definitely get a slowdown in the market and it could look different for a period of time. But I think in the longer term, that's what's going to transpire. Coming on back, we've got, one last thing. The bottom here, this is oil's 7-year rate of change. You can see we've got the three humps coming down in a possible resistance line coming through here. And once that breaks, we're going to go up bigly. We're going up bigly, 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 bigly. You can see we broke that there in the 1970. And then the hump in 2000, 2001. I think when we break it this time, we're going up big, big time. We're going to make the 70s look like nothing. And the reason that we're going to make the 70s look like nothing, the 70s was we hit peak oil, but we had very low debt, very, very low debt. If we hit it this time, this is going to be like money printing galore because it's like the game ending move on the currency. And oil is going to go into a shortage, like a permanent shortage. So the whole market's going to have to reconfigure itself. And I think currencies are going to be sacrificed. So I think gold's going to rip, silver's going to rip. I mean, they are going to rip. They could easily outperform oil, even though oil is the front and center problem. We're going to do everything in our power to probably use fossil fuels in the future, coal, including coal, if this does transpire the way that I think it will. And then the currency is going to get smoked. I mean, it's going to get smoked. All right, coming down, crude and condensate output dropped 11.3% as mature field depletion and slow new well completions drag on President Sheinbaum's 1.8 million barrel per day production goal. And that's Pemex, which is the Mexican um, oil producer. So they're having very strong output drops in their oil and natural gas fields. They had a big find back in the day, and it was a big producer, the Cantarell field, where that thing was pumping many millions of barrels per day. I think it was 3 or 4 million barrels per day from that field at its peak. But that's peaked, and it's been a while, and now it's starting to deplete pretty bad. This also will have an impact because we're going to have to supply Mexico with its natural gas needs from shale production. Now, keep in mind, we also have our own large demand growth for electricity burn in America, and we've got a wall of LNG export capacity coming. So we better figure out if we can produce a whole bunch more natural gas. There are people who think that we cannot produce as much natural gas as takeaway capacity is being put in place. I'm not sure if that's the case, but I'd like to see what this thing can do, what the America can do in terms of maximum capacity for natural gas. But remember, once you hit max capacity, you'll peak and you'll turn over at some point, just like all these other fields are in the world. Potential triple bottom in the U.S. dollar divided by Japanese yen chart. Time for the dollar to blast, at least in the short term. Potential triple bottom. Heading to Omaha this weekend, Berkshire's annual meeting. It says, what has Buffett been buying with this record 340 billion cash hoard? Well, I don't think he can invest in much because, I mean, it's not like you're going to go out and buy some small caps or mid caps with 340 billion, because then you just start taking over all the companies. So I think he's pretty limited, and that's probably why he's in cash. He thinks that there isn't a lot of good opportunities at this exact moment. And that cash position, I don't think it has anywhere to go. That's my guess at current valuations. Tavi says the market is fixated on the prices paid index released this morning. Meanwhile, the ISM Business Production Index has collapsed to recessionary levels. The 2-year yields are wildly misaligned with economic fundamentals, in my view, and probably need to be cut in half to reflect the current state of the economy. Now, here's the thing, though. Are those yields reflecting the inflation, or are they inflecting what the economy is experiencing? I would say that interest rates are a function of the supply and demand of your bond market. And if nobody wants your bonds, I don't know if the economy matters at that point. Because, hey, look, we need to sell a whole bunch of 10-year bonds. Nobody buys them. So what do? They're going to sell them on the short end of the curve wherever the demand is. So if people are more willing to buy on the short end of the curve, what the Treasury Secretary did is release a lot more bonds on the short end of the curve. That's what Janet Yellen was doing. She was putting the bonds where the demand was. But what if you don't have demand anywhere? What if you have so much supply that you overwhelm the demand on the entire curve? Well, then your entire curve goes up, irrespective of your economy, perhaps. I don't know. Coming next. Critical, strategic, and precious metals are leading the pack this year. Antimony is up 231% or so. So this is critical, strategic, and precious metals are leading the pack this year. Antimony is up 231%. We got cobalt, gold, copper, tin, silver, platinum, palladium. Those are our leaders. You can see crude oil down here at the bottom, zinc, nat gas. I like these as investments coming up in the future. I think with them being down, they could stay down for a little while. Don't get me wrong, but they're underneath their cost curves. I can say gold is not underneath its cost curve, but we need to go to demand destruction. If there's more demand than supply, then we got to keep pricing it higher until it destroys the demand and things start to balance out. Charles Payne says Financial Times' hatred of Trump is so intense that articles they print to slam him often include evidence that there were problems long before the current term. Same store sales at McDonald's have tumbled for 5 years, but all of a sudden business is slow due to tariffs. Um, so McDonald's U.S. sales dropped by most since the height of the pandemic. I haven't eaten at McDonald's for, I'm not exactly sure, probably about 10 years. I haven't eaten at Taco Bell, McDonald's, like any of those places for probably close to 10 years. I have gone there in the past few years for my kids going there for there's been like after parties of um, like a kids party, or maybe they go there and eat after a tournament or a baseball game or whatever it is. So I have been in there a few times. It's not like I haven't been in there, but I will say this: the prices have gone up dramatically. I mean, dramatically, and I consider that food to be absolutely horrible. I don't put it in my body at all, no matter what the cost is or how cheap it is. But one thing I do notice is that the price has gone way up of that food, and I think that's probably having a pretty large impact. If someone said to me, "Would you rather go to Chick-fil-A or go to McDonald's?" Well, for me personally, I would choose Chick-fil-A, or I would choose something else like a Chipotle or something on a different company, right? Um, but when you look at, say, a company like Wendy's or McDonald's, or I don't even know if Burger King exists anymore, but um, yeah, those companies, the prices have gone way up, and they're not very good food. It's, so this isn't surprising to me that when you have a peak of inflation and then inflation keeps coming down, a disinflationary period, that we're seeing prices fall of this type of food that's gone up as much as it has. Cycle Bottom says the drop in spot conversion is a good sign for the bottleneck peak. So this is SWU value. SWU value is the refined product of uranium. That does not look like to me that we are in a bear market. It looks like we're in a massive bull market. It turned in 2018-19, and then we've been up ever since. So this is the refined product. I know people are staring at the uranium spot price. Um, this looks good, guys. This looks good, and I don't know why people would be bearish for this at all. Unusual Whale says U.S. debt to grow twice as fast as the economy. Look at the forecast of our debt. My Lord. We blow through 150%, blow through 200%, blowing up to 250% debt as a share of GDP, actual and forecast. Yeah, that's called a problem. That's called a problem. I'm wondering, we had a pretty big debt problem even in the 40s. So this was an increasing interest rate environment from 1940-ish, early 40s, all the way to 1980. And then you can see that our debt to GDP started to grow as interest rates peaked in 81-ish area. Against all odds research, it compares the three major asset classes, bonds, equities, and gold, each relative to commodities. It's telling you one story. When the world shifts towards tangible stuff, energy, metals, and food, everything else gets repriced. So there's the Fed funds rate coming on down, and we can see that this is starting to move on up. We've got bonds is the one that's down here. We've got commodities that are ripping and gold that is ripping. and that is your New York Stock Exchange Index divided by composite. And he's got these three there. Gotcha. So commodities look like it's ready to rip with gold here any second. Just in, U.S. Treasury Secretary Scott Bessent calls for immediate deal with China. We need to see a de-escalation with China on tariffs. I don't know, this guy posts a lot of information, and sometimes he gives you a kind of like firsthand information before it comes out. So maybe they've got something in the background. Fingers crossed. Keep in mind that we could easily see a slowdown in the market due to tariffs, but that could also change with one. That could change with one phone call. That could change with one decision where they reverse everything very quickly. If they reverse things quickly, then we could see a very big move higher. It could reverse with negotiation. Maybe they negotiate something. Maybe they don't. It's a tough call, but he does tweet things like he tweeted earlier about the VIX most likely peaking and rolling over, almost like he had some sort of control over it. He also tweets a lot about cheap energy prices and the price of gasoline and how it's stimulative. So there are some things where it makes me think like, are they holding the oil price down? Because if you look at inventories, they would suggest higher pricing. But maybe these tariffs go through and maybe we do kill some demand. The projections that I saw of the killed demand, it is killed growth. It's not an outright contraction. They're calling for the growth to slow of oil production growth. What utter nonsense? China was closed today for May Day holiday break. The selling was executed by traders looking to take advantage of the Chinese absence. And this one here is China just dumped 1 million ounces of gold, but they're closed. Be careful what you're listening to and what you're reading. Chinese purchases of American oil are down 90% year over year, while Chinese purchases of Canadian oil are up plus 700% year over year per Bloomberg. And this is new pipeline allows Asian country to lessen dependence on U.S. crude. So they're importing more crude from Canada and less from America. This is natural gas demand that's still coming. I think people are so fixated on oil going down or the price of a commodity going down. This is for natural gas. This is the wall of demand that we are in and is coming. We're in 2025 here. We had a couple of additions come online here, and we're going to have to produce more natural gas for this. And then we still have a wall coming of demand. I haven't seen a better setup in my life ever, where these companies are trading at price to book levels of 0.4, 0.5, ridiculously cheap, and we have a wall of demand that is for surely coming through. We also have a bunch of demand growth that is projected. This is from Antero Resources, kind of their slide deck on the fundamentals. So robust natural gas demand growth. LNG exports are going to go up about 20 billion cubic feet per day. AI data center plus about 7, and Mexico exports up about 2. And that, when you add it all up together, I mean, this is 104% growth between 24 and 2030. That's a wall of drilling that hasn't occurred yet, if you get what I'm saying. Lance Roberts says, Lance, why do we own gas companies and drillers with oil prices going down? He says, America's data center boom is largely being powered by gas and coal plants. Electricity generation for U.S. data centers. So gas and coal. Gas is going to be the big one. They have renewables up here, but I hate to say it, renewables are going to be powered by gas. That gas is the backup for renewables. So if renewables don't work, the sun doesn't shine, the wind doesn't blow, it's at night, it's going to be a whole bunch of nat gas. Look at the blowout of natural gas from 2015 to where this projection is in 2030. That's all drilling that needs to occur. That hasn't occurred yet. We need higher pricing. Expound the profound. It says, for those wondering why the price of oil is collapsing, it turns out blocking trade kind of stops massive ships from burning massive quantities of oil. Just so you know, oil equals inflation. It's in everything. You don't exist in modern society without it. It also is why store shelves are going to be bare soon. I don't think oil is going to be why it's going to be bare, but um, they do burn, these ships do burn oil, but we also have trucks that are going to be there's going to be a little bit less of trucks hauling this stuff around as well through America. But I don't think it's actually going to kill demand. Uh, I don't think that we will be down by 1 million barrels per day. The great financial crisis at its peak of the entire world in 2008 saw demand reduced by 1 million barrels per day. The current pricing that we're at, we're probably going to see supply destruction to some degree as well. So I think that demand growth will slow. It won't go negative like 2008 is my guess. Could be wrong, but that's my guess there. And I think we're going to have supply problems within 0 to 3 years. What I'll say. Trump shift. So Trump is getting lower oil prices, but it's not due to drill, baby, drill. In fact, with current oil prices, drilling will stop. A better slogan is chill, baby, chill, or you could say deplete, baby, deplete, as we deplete through things. It's not more supply that's bringing down oil prices, but collapsing demand due to reduced trade and recession. I would actually say that that is not 100% correct. It is the perceived future collapsing demand that could be due to reduced trade and recession. We actually haven't observed collapsing demand yet. So a lot of people are saying that this demand is going to collapse, but it's the perception of the collapsed demand and the future perception of that demand collapsing that is causing the price to go down. It hasn't actually been realized or observed yet. And that's what I want to see. I want to see what we actually observe. We've been eating through inventories basically continually in build season. I'm going to say it one more time. During build season, we are eating through our inventories. We are running big deficits. Now, I want to see what this quote collapsing demand looks like coming up, how big it is, and what it looks like. If people, well, I just want to see what it looks like, and then I'll make my decisions there. Grant Isaac says, until we see stronger demand in the market, until we see utilities calling for that, that's for uranium, the investments won't be made to fill that red wedge. 70% of utility needs through 2045 remain uncovered. That's 3.2 billion pounds. Tim Gitzel, who's the CEO, I think, of Cameco. With each month that long-term contracts remains below replacement rate, this only increases. So we can have a problem out here in the future with uranium supply. Marco says in a recession, people prefer to eat at Microsoft. Says McDonald's U.S. sales dropped the most since the height of the pandemic. Oil sentiment check, short thread. We've got $65 oil nobody wants to buy, but everybody wants to buy when it's 120. That's just the way human nature is. Freight futures AM update. Dry bulk, Capesize is up 3%, Panamax up 1%, and tankers are up. VLCC up 2%, Suezmax flat. Brady's saying posted on gold's huge 13-year breakout in the linked post below 15 months ago in real time. Said silver would follow, and it did. Then said it looked likely that gold would just blow through the 45-year blue, then resistance line, and not be stopped by it, and it did. Now silver is following gold for the 45-year breakout, just like silver did with the 13-year breakout in the linked post below. It is extremely important to recognize a new market environment when things change. So there it is. We're starting to break out of the silver yearly candlestick chart, break into the upside. That gold has already broken its resistance line. Um, it's ready to move, guys. And I know these are all from very big picture, long views. They're not the short term little candlesticks, guys. So, yes, we could get a pullback in the next week or two, but on the longer yearly looking charts, these things are going to continue to just rip. So, I've been in silver for a while. I've got a whole bunch of holdings in it, and I'm playing the big move here. I bought it actually down here at this bottom here, 2018, 2019, 2020. Bought the whole bottom through here, and then I'm just riding it all the way up. I'm not going to do anything different. My reasoning for buying these assets is that I don't think that we can stop the inflation. I think we have to continue inflation because of our debt situation. I think interest rates will go up, and eventually people will get scared into precious metals and away from bond markets and currencies. So I just positioned early. I bought a whole bunch, and I'm just riding this thing. Breakaway, China steel industry PMI index at 50.6, which is positive. Following a 46 in March, new orders are up 10 points from March, which is interesting. What happened to OPEC bringing on millions of barrels? What happened to the ending the cuts? We are all being lied to. OPEC plus crude exports have been declining. They're not up. We'll see. We'll see. And there's one last thing I want to cover here because this is kind of the end of this. I want to read something real quick. What this is, and I can move this over so you guys can see it here. This is just Howard Marks, and I just wanted to read this real quick on his opinion on buying bottoms. He says, in his book, Mastering the Market Cycle, Howard Marks discusses the difficulty of timing market bottoms and the risk of waiting too long to invest. He discusses the concepts of falling knives, aka catching a falling knife, where investors fear buying before a market decline stops, leading them to wait for certainty. However, by the time the market stabilizes and uncertainty is resolved, the best buying opportunities are often gone. Mark argues that bottoms can only be identified in hindsight and that during downturns, larger quantities of assets are available at lower prices. Therefore, he prefers buying during market slides rather than waiting for a confirmed bottom. Here's an excerpt from the book. The question I want to touch on here is, when should one begin to buy? I made reference in earlier chapters to falling knives, which constitute a very important concept. When a market is cascading downward, investors can often be heard saying, we're not going to try to catch a falling knife. In other words, the trend is downward and there's no way to know when it will stop. So why should we buy before we're sure the bottom has been reached? What I think they're really saying is this. We're scared, in particular, of buying before the decline has stopped, and thus of looking bad. So we're going to wait until the bottom has been reached, the dust has settled, and the uncertainty has been resolved. But hopefully by now I've made it abundantly clear that when the dust has settled and investors' nerves have steadied, the bargains will be gone. At Oaktree, we strongly reject the idea of waiting for a bottom to start buying. First, there's absolutely no way to know when the bottom has been reached. There's no neon sign, the light that lights up. The bottom can be recognized only after it has been passed, since it is defined as the day before the recovery begins. By definition, this can be identified only after the fact. And second, it's usually during market slides that you can buy the largest quantities of the things that you want from sellers who are throwing in the towel, and while the non-knife catchers are hugging the sidelines. But once the slide is culminated in a bottom, by definition, there are few sellers left to sell. And during the ensuing rally, it's buyers who predominate. Thus, the selling dries up and would-be buyers face growing competition. So I wanted to just read that, and I'm sure he probably buys copious amounts of stock, so his situation might be different than some of our situations. But more or less, I still think he's right. If you're trying to catch a bottom where fear is maximized and everyone's selling, it still makes sense to try your best to get as low as possible. Other people will tell you that you're crazy that do technical analysis. They wait for all these trend lines to break. They wait for the uptrend to be established. But a lot of the upside, uh, I'll say a lot of the asymmetry has been consumed waiting for confirmation. Some people think that's better because they don't see any downward move in their portfolio. Others, uh, like myself, I don't play that way. I'm okay with riding through some volatility as I cost average into a position and create those positions more towards what I would consider to be bottoms. But that's what I wanted to share with Howard Marks there. That's all I've got for today. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you guys like. You can use special as the coupon code. And we've got that 5 p.m. Mountain Time Sunday session coming up here. All right, guys, we'll catch you later. This is Finding Value.